Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Daryl, great to be able to catch up with you. I think that there's so much obviously in the news right now in terms of supply chain constraints, commodity shortages, particularly in the lumber space, let alone on the semiconductor side of life, hitting some of the tech stocks or concerns there. So we wanted to get caught up with you in terms of the big picture here. And what was so interesting to me when I was reading your research, I had to do a double take. You were writing about a super cycle, a lumber super cycle back in 2010. And here we are, 2021. So maybe give us the kind of the top-down perspective in terms of what you saw then and obviously how this is playing out.
Well, great. And nice to see you, Catherine. Nice to be here. Well, coming out of the Great Recession, when we saw housing really, plummet, went down 80% in the US. And, the stocks that I cover, obviously, they were just trashed as well. But, through that fire, we saw the setting up for a very tight market condition. And it really was three factors that we identified way back then. And we'll be honest, they took longer for these trends to play out, but we've seen them emerge now, and they're quite simple. It's the emergence of Asia as a new market, and normalization of U.S. housing demand, and the structural supply changes, permanent, that are coming out of BC with the devastation associated with the mountain pine beetle.
And so if we break those down a little bit, when you talk about the normalization of U.S. housing, what do you mean?
Well, if you look back over the last 50 years, Catherine, we've built about 1.5 million housing starts in the U.S. And, that even goes back to where population levels were much lower. So that's kind of a normal level of housing. But if you look over the last decade, since that great financial crisis, the housing starts are running far below replacement value. So we've seen underbuilding, frankly, in the North American market for a long time. And so part of that resurgence in housing that you're seeing right now is trying to catch up from that underbuilding potential.
When we look at some of the building and the existing home sales data that's going on, obviously it's had a huge run essentially since the financial crisis, with some volatility. But I always wonder, when will that stop? It doesn't sound like from your perspective that it will, because it's been underbuilt, but do you have a concern with respect to the housing market in the United States and also, of course, interest rates?
No, those are great questions. And I think, my first point, we haven't really dug into supply yet, but
yeah,
to me, supply can't fix this. It will be on the demand side. So your question's a good one. That's where we should be focusing our attention. I was on a investor call with our home building analyst out of the US, Buck Horn, who is an excellent analyst and was early to identify this resurgence in housing. He's based in Florida, and he was on the ground and he saw this develop, this time last year, which was, I think it caught everyone but surprise. But, he identifies some trends that he's seeing right now that really speak, like he's actually using the term super cycle as well to describe the home builder stocks. And some of those factors, one of the big ones that, I thought really resonated with me on that call was the relocation trade. So, as a fallout from COVID, you see structural factors like we talked about, for instance, like demographics, like, the biggest cohort in the US is just turning 35, prime home building years. And so you're seeing structural demand from that. But COVID has changed things. And, the ability to work from other places has meant that about 30 to 50% of the transactions in the US are relocation trades. So think about that, moving from an expensive jurisdiction on the coast to, Texas and places like that. And not that price sensitive or interest rate sensitive. These, when you're selling a house and buying twice the house for half as much, not so concerned about price right now.
Well, what does that mean though in terms of net? Because if it's a relocation trade, it seems as though obviously the construction that would be going on maybe in the Northeast might not be taking place. So net, why, I guess it's new construction or new build that is the demand side, but
Right.
what do you see though elsewhere?
No, and it's a good question. It's just simply a lack of inventory. So there is, Buck has a great chart and his deck shows, for sale inventory at historic lows. And so if you do want that house, you do need to build it. And, listening to the home builders commentary on the quarter, very interesting discussion around that. No, there's essentially no spec building going on right now. Like historically for a home builder, they will, entitle land and get those subdivisions going, and they're not sold. It's spec housing. That's not happening right now. And so, a very healthy building market. If anything, you're starting to see a bit of a slowdown in housing recently, simply for lack of supplies. It's hard to get the lumber, it's hard to get the OSB, and it's wider than that. Appliances, everything seems to be in shortage. The entire supply chain seems to be constrained. So, you are seeing builders purposely slow down a bit right now just to catch up.
Mm-hmm. Right. So we are seeing a slowdown in so many respective areas. And people are attributing that to the fact that we couldn't see appliances being built during COVID-19. You're also seeing people perhaps double order. So will that be transitory?
I think for different industries are different. And, this industry that we're talking about right now, building materials, there is no pent up supply available. You can imagine, back in 2010, excuse me, when we published that piece, we were thinking of maybe prices might get to $500. Wouldn't that be amazing? And, you're seeing spot prices today of 3 times that or better. And so you can imagine if you have a sawmill today in the last year, look, you're cranking out just as much lumber as possible. So it's not like there's available supply. In Canada, we harvest sustainably by law. And so there's no ability to increase production out of Western Canada or back east. And, if anything, we're probably going to see more reductions to the timber harvesting land base going forward, even further reductions, especially in Western Canada. So you're really left with the U.S. South, and there's a lot of logs there, but it's kind of tricky building a greenfield sawmill, believe it or not.
Well, and why is that?
Well, there are constraints in the specialty equipment required to put in a new mill. So, you're talking at least 2 years to get that equipment manufactured, delivered, assembled, and get it up and running. So that's a constraint. The other 2 big ones, labor. These specialty, sawmills aren't as old school as they used to be. There's a lot of technology, there are robots and computers. It takes a lot of training, and the available workforce is constrained. These are typically going into small populations in the U.S. South, and very, very difficult to get labor. And even now, the turnover, with some of the established facilities there is still 30% year on year turnover at those facilities.
Why? That seems like not easy, but management should be able to rectify that a little bit, no?
Well, they're not great jobs. They don't pay a lot. They're typically outside. It's 100 degrees and 100% humidity. And, they pay kind of like the same as a Walmart greeter. So difficult to attract and retain employees in that venue. The last one is wood chips. So when you saw up a log, half is lumber. The other half is wood chips and sawdust, which will typically go into pulp mills. And that's a very important revenue component for a sawmill over the cycle. It's around 15% of profitability. And you need 2 things, freight logical and credit-worthy counterparties. And, there's no new pulp mills going in anywhere in the Northern Hemisphere. So that's another constraint. Those 3 things are really limiting the greenfield replication.
And so when we think about then the supply side that you looked at back in 2010, what exactly is going on in terms of why we are so constrained?
Well, the big one was the mountain pine beetle. So, back in around the year 2000, the mountain pine beetle swept across British Columbia. It killed 70% of the mature pine trees, which is about 40% of the harvest. So these trees were killed, and now they could still be used to make lumber. But every year they dry out and get degrade over time. No one was sure exactly what the shelf life would be, and that's one of the reasons why it took that long for the supply crunch to hit, because the companies are actually fantastically innovative, and they put in a lot of technology to be able to salvage this dead pine. And so at one point, 90% of the logs harvested in British Columbia were dead pine. And really, if you think about the last 20 years, it's been a large salvage operation in BC trying to get this dead pine out while we still could. And again, the companies did a great job, and it lasted longer than they could. But beginning in 2017, 2018, the chief forester started reducing the harvest levels around 30%. You saw a period where there was over competition for these scarce logs, and 2019 hit the first half, and prices were low. Log costs were high, and that was really what happened. You saw 20% of BC shut their sawmills permanently. And, that really hit the market in the back half of 2019. And that's when housing started perking up. So you actually saw prices start moving up in 2020, ahead of COVID and ahead of all this. And so there was already that structural tightness in the market. And like I said, there's not an ability now to crank up production. We simply don't have the wood fiber. We don't have the timber.
And so what's the tipping point then, I wonder, in terms of the price for lumber, really for the builders and construction?
Well, that's a neat thing about lumber. Demand is almost perfectly inelastic. So you've seen a lot of news reports about the cost of a home going up by, $20,000, $30,000, $35,000. However, it's still not a huge component in the home. If you're a builder and you're building a subdivision in Texas and you have framing crews on the ground, you'll literally pay anything for that rail carve lumber. Wow. And so demand is very inelastic from that point of view. And then the other interesting component here is home builders have been able to pass off these costs. So Buckhorn again was talking about one home builder he talked to that were able to increase prices by 10% this quarter alone. Which far outstrips the inflation they're seeing on the input side. So I think builder margins are strong. Affordability for the U.S., you still look at things like wage growth has been good, and other stimulus packages. So from a demand point of view, and one last thing, substitutes. I mean, we did hear talk over the past years about steel studs and things like that, but it's not like steel prices are low either. So, there's not really great affordable substitutes either. So if you want a house, you're going to have to chin up and pay these prices.
When we think though as well, I guess one of the other aspects that got talked so much about in the news, and I'm not sure where it fits into the whole overall macro picture and your, looming, or what we're in, maybe a super cycle for lumber. But the tariffs, I mean, if we go back to President Trump slapping on tariffs on Canadian lumber, how does that factor into the tightness?
Well, I guess my first comment on, it wasn't just President Trump. We've been fighting this battle for 40 years. My first job was an analyst at the Forest Service, fighting the lumber wars, as we called them at the time. And so this has been going on, 40 years at least. So it's an ongoing battle. And so the most recent round, I think it did factor in. If you look at those closures that we saw in British Columbia in 2019, I mean, we had low lumber prices, we had high log costs, and then we had a 23% tariff on top of it. So it was definitely a factor that led to those permanent mill shuts, which leads to the shortages that we're experiencing today. There's no question about that. But, relaxing those tariffs now will not mean that those mills are coming back. It's not going to alleviate the tightness we see today. That's a timber supply issue primarily. Tariffs contributed to the closure, but removing them is not going to bring them back.
And sorry, go ahead.
Well, you are seeing talk today of, pressure from home builders and associations. The other thing I'd say is that, the lumber lobby in the U.S. is incredibly strong. It's primarily timber landowners and some sawmills, and it's an incredibly strong lobby. Historically, the National Association of Home Builders and others have not been an effective counterparty. So now we'll see what $1,500 lumber brings, whether they will be. But I don't really see, there's certainly no talks going on right now or negotiations.
Mm-hmm. And so what is it though that the US builders are advocating for as it relates to the Canadian lumber industry? And I'm asking that in the sense that how much supply does the United States have? How badly do they need or want Canadian lumber? Does that satisfy some of their supply side constraints?
So historically, the US lumber industry could make up about 2/3 of demand. And so the US has always been required to import about 1/3. And guess what? Canada's long about 1/3. So, it's been this kind of natural trade balance that's fit together very well. The emergence of the Asian market, in particular China, has thrown another level of demand, and that's something we wrote about back in 2010. And especially with the dead pine, I mean, the Chinese were using this for non-structural purposes. So some of that lower quality wood that we were making from salvaging the dead pine found a ready home in China. So, but that's new, right? So that's another source of incremental demand that kind of upsets the balance in North America as well.
Understood. So when you step back then and you think about investing in whether it's building material stocks, home builders, and of course some of the lumber companies, what's your big picture view these days in terms of the kind of risk reward we might be able to achieve?
It's a really interesting time. Historically, the stocks I cover were 85% correlated with the spot price of lumber. And if you could figure out where lumber's going, you figure out where these stocks are going. That relationship broke down over the past 12 months. And I think it's a function of just how surprising the rally was. And, the stocks were absolutely crushed when the lockdown started a year ago. And then, the price of lumber suddenly gapped up, and it quickly went, through a strong market to an insanely strong market. The previous high in lumber was $650 in June of 2018. And that rally only lasted maybe 6 weeks. We're into 9 months of well over $1,000 lumber now. And, from your trading days, that chart was quite intimidating for a new buyer. A lot of people thought they just missed the trade. And, the stocks even today, when you take into account the free cash flow that they're throwing off, they're pricing in like a $450, $500 lumber price. That's it. And the spot price has tripled that. And so on one side, I see, tremendous value here. Like Interfor just announced a special dividend, which was $130 million. So 1 month's free cash flow, a 6% yield. I know it's insane. Like free cash flow yields today will be 50, 60%. 5-0, not 15, 5-0. And so I see that on one hand, the stocks is tremendously undervalued from a fundamental point of view. The trick shot here, though, is, at some point, inventories are going to catch up and the boil is going to come off and these white hot prices are going to normalize. And, historically, even if they normalize to something incredible, the stocks might be pricing in 500, but say they normalize to 850 or 900, the stocks will be under pressure under that adjustment. So that's the trick shot here. Incredible value, incredible free cash flow, balanced by, a commodity going the wrong way and the stock's just reacting poorly to a commodity trade.
When we think about the valuation of the stocks, what you kind of described in terms of the length of time it takes to have more supply, it's years, obviously, but what will the market do with these stocks in terms of pulling forward that effect, the forward discounting mechanism of markets? How do they look at supply coming back on from a timing perspective?
So you're 100% right. It's, before we see material supply come on, it will be years. And although like the other factor here is, the supply chain is long, and the reason we're seeing such really, really high prices is the fact that supply chain just hasn't had ability to catch up. And so, you see the pro dealers and some of the other end users, do you want to take a position today at $1,500 lumber and build big supply? No, it's a tough one, right? And so I think, seasonally, demand tends to weaken. And so we think prices stay strong through the third quarter. The fourth quarter, just from a actual building activity, it's typically 25 to 30% lower. That's when I think we could see, that inventory catch up. And so maybe prices go from 1,500 to something lower. And I don't know, maybe it's $800. But, $800 lumber is fantastic. Like the return on capital employed would be fantastic. So, I think, that $600 to $800 range for lumber is something we're going to see for the next few years. And I think once that range is established, that's when the market's going to buy into these stocks and really start pricing in that higher level. So,
So not right now, then. Don't necessarily step in right now if you haven't already.
Well, look at a stock like Interfor. Interfor reported in a normal year for Interfor, they'll do 250 million EBITDA in 1 year. Last quarter, they did 392 million, almost 400 million in 1 quarter.
Wow.
Prices are up 30%. If I look at April, and price hasn't gone down, prices are sold, and these companies are selling into July now. So if I just look at April and multiply that by 3, Interfor could have a 6 in front of it for the second quarter. Again, a normal year is 250. So I certainly wouldn't be selling ahead of this. I think then that free cash flow. And so, the way I think I'd play it, I would keep my positions here. I wouldn't try to get cute. But on a pullback, if the price does come down a bit in the fall, I'd load up again because I don't think this is over. Not until demand starts to falter when we see no signs of that.
Right. Where are the institutional guys on this? For our viewers to understand that's who in many ways you service, the big money managers, hedge funds, et cetera, in terms of your research and your calls. Have they been participating in this trade? I mean, obviously some have, but where do they stand these days?
Yeah, it's a great question because, again, historically, the fact that the spot price and the stocks are so heavily correlated was exactly that fund flow that you're seeing from the big institutional managers. And, typically what happens is the value players will get in early and there will be a handoff at some point to generalist investors or even some of the quicker money players. That handoff has kind of been interrupted. And again, I think it was just the nature of sentiment being so poor, and then just how quickly the commodities and stocks reacted. It's been a tough chart to buy, so we aren't seeing the same participation as we would in a typical cycle. One thing that is interesting is West Fraser acquired Norbord in the first quarter, so the largest lumber manufacturer bought the largest structural panel producer. And in association with that, they have a New York Stock Exchange listing now that became active in the first quarter. Many of my calls now are coming from U.S. investors. And I think it's really healthy for the industry because, a stock like West Fraser now, all 3 of their commodities are at or near record levels. And the amount of, again, earnings power for this company, and I'll talk to a U.S. investor and they'll say, really, 15% free cash flow yield, that's fantastic. I'm like, no, 50. And, you just don't see those kind of opportunities every day in the U.S. where the market's, far more liquid and efficient. So, that's West Fraser is on our analyst top picks. And, that's a key reason why I think some of this incremental fund flows are going to lead to, better equity valuations.
And when we take a look at the names that you do cover, you've talked about Interfor as well as West Fraser. Those sound as though they're 2 of your top picks. What else should we be thinking about?
Well, another stock I really like is Mercer International. It's a bit off the, it's not as well known as the others. So they're primarily a pulp producer. They have assets in Canada and in Western Europe. And but they bought a sawmill a few years back. It's now the largest sawmill in the world. It's in Germany, and they're also producing very good returns, not just in pulp but also in lumber now. And the other factor here, which I think the market's just waking up to, is just how ESG friendly these stocks are. And Mercer's a great example. They went from 60th percentile with MSCI and their risk ratings to 20th this year. And, the reality is, lumber in a home is carbon sequestered for as long as that home stands. And, it's 75% less carbon in a wood building compared to concrete and steel. And not only that, their pulp operations produce power, which is supplanting coal. So you got green energy, renewable power from pulp mills and cogen facilities that is supplanting coal. So to me, that's a really unsold story for this entire sector. And Mercer's an example of that, but Interfor just came out with a sustainability report, brand new off the shelf. And I think that's going to be really interesting for investors as they discover these, especially those ESG funds that are all the rage these days.
Well, and that's a great point because, they are all the rage, the ESG funds. And I often sit back and I say, well, how many companies are you really able to invest in? You really have to understand those details and where the company's going. So to your point, I mean, if they're on the hunt. And I think that it is actually really hard to find companies that can go into some of those funds.
Yeah, and the industry hasn't done a great job of telling its story, but that's changing. And they're hiring sustainability directors and getting these reports out and really not doing anything different than they've done for the last 30 years. But it just happens that the business is inherently sustainable in its nature. So it's a good story to get out.
Mm-hmm. And just I'm curious, I'll look it up, but just for yours, Mercer International, where is that trade? What's the ticker? MERC
on the NASDAQ.
Oh, okay. Got it. And you mentioned something earlier at the top, which I thought was really interesting. You said that the harvesting in Canada is sustainable harvesting. So in other words, you can't increase supply quickly, is what I'm hearing from you. Is that accurate? And how does that compare to the United States?
It's quite a bit different. Yeah, and it is accurate. So in Canada, in BC by law, we must plant 2 trees for every tree that is harvested. And less than 1% of the timber harvesting land base is harvested each year. It's a fantastic environmental story in British Columbia, and I'm proud to be out of BC, and I'm proud to be associated with this industry. And it does take a long time to grow a saw log. Canfor is one of our other big picks, and they have a big presence. About 50% of their assets are in BC, and they're very active in this area. And they'll confirm that it takes a long time to grow a saw log in BC. It's very different in the South. When the financial crisis hit, harvesting stopped for a few years, or didn't stop, but definitely severely curtailed. And it only takes 20 to 25 years to grow a saw log in the South. And so it's a very different picture down there. We have really a glut of trees, and it's interesting because the large timber REITs like a Weyerhaeuser or Potlatch or Rainier, they're not benefiting to the same amount as the lumber companies because log costs are still pretty flat in the US South. And it's because there's just so much availability of logs. And it's really just supply demand there. So, it's a huge windfall for sawmills because their input costs are not going up. And, again, Canfor, Interfor, West Fraser all have material holdings of in the US South. And it's a fantastic place to be. Lumber prices high, input costs low. It's fat margins for them.
Okay. And Daryl, just to kind of wrap it up here, you were writing, as we talked about a super cycle in lumber back in 2010. Obviously, it took a little bit of time to catch up, to actually see that come to fruition. What are you thinking about as you think about the length of the super cycle?
Well, we talked about the supply side. There will be incremental production coming out of the US South. But mills there are pretty small. It's only 250 million. I think as an offset over the next 5 years, we're going to see less lumber production out of BC and Alberta, and it could be as much as 2 billion board feet. So, that's 8 to 10 US South greenfields to just keep things where they are today in terms of, the supply demand balance. So again, I'm a little bit cynical on supply being able to increase to the point to solve this problem. I think it's really going to be demand. And I look at, things like affordability, if we quickly go to a 4% 30-year fixed rate mortgage, combined with some of the price inflation we've seen, especially for, starter homes, that's probably what brings this cycle to to more of a pause here. And so there's no signs of that. We'll see housing start data come out on, I think it's Thursday this week. Every indication I see is that, that market remains really, really hot. But to me, that's what I'm going to watch to see, where there could be a more durable balance here.
Understood. Okay, Daryl, great to see you and get caught up with you and your insight and views as always. So thank you.
Thank you, Catherine. Great to see you as well.
Thanks so much. We'll speak to you soon.